Okay, so today we're going to talk about mutual funds, and you guys will have to bear with me. It has been a very long day. I'm quite exhausted. So stick with me here, people. We're going to get through this. All right. So before we get into mutual funds, let's talk about the market and give a market update. So if you've noticed, the markets have been coming back up nicely since October when all of this began. So it's been coming up nice and easy. It hasn't had big leaps and bounds upward, which is good. We don't want that. We want it to be nice, slow, steady gains because then it's more sustainable. Hopefully you guys were able to take advantage of some of the volatility, and hopefully that's been a benefit for you. But we'll continue to see the market pushing upward. Again, there's no data that's showing this type of market volatility is justified. And that's fine. I mean, like I said, it's nice to have a break for the market so that it can move, take a breather and then move upward and push upward further. And that's what we're going to see. Not to say that we're not going to continue to see volatility, which that should never be a surprise, people. I mean, come on, it's the stock market. Of course, there's going to be volatility. So just automatically assume that that's going to happen. But as far as why it's happening, again, there's no data to support this type of movement. It's just there's a lot of just panic, undue panic. Now, there is something that I did notice that the Federal Reserve has been slowly unwinding that $4.5 trillion out of their balance sheet. And so there has been definitely some analysts and economists and I tend to agree with this school of thought, that them unwinding it is starting to affect the markets, and most definitely it would, just because that was artificially, infused into the economy. So naturally, it would have an effect when it starts coming out. So again, they're very slowly unwinding this. It's going to take them a long time for them to undo what they, pushed into the U.S. economy in 3 years. It's going to take them longer than that to get that money back out. It's going to take them a very slow movement to do this. So don't be surprised to see, again, some volatility, but again, we're seeing a trend going back upward. The Federal Reserve wouldn't be pulling the money out if they didn't feel, again, the U.S. economy couldn't take the hit. So again, that's all good signs. So as far as, the Fed's moving the interest rate, like I said, it's anticipated that they'll probably move twice this year. So barring any weird phenomenons happening in the market. So anyways, all right. And like I said, I'll do another video in the future about why China can't afford the trade war, which I've told you guys for months since I started doing these videos. And I'll clarify that. I really need to clarify that because, we keep talking about the trade disputes. So I'm going to have to do that video sooner than later. But anyways, all right, mutual funds. Let's talk about this. So the reason this topic is so important is because the vast majority of Americans are invested into mutual funds, whether they're aware of this or not. And the reason that they're invested into mutual funds is because a lot of people hold 401ks. They're retirement plans that are sponsored by your employer. And so most people have them. And if they're offered to them, most of them are participating in it. And that's the vast majority of investments offered inside the 401k or employer-sponsored retirement plans are mutual funds. So what are they? How do they work? So this is going to be just a basic overview. We're going to have to do multiple videos on this because there's just so much to cover on mutual funds. So mutual funds you can consider like a pie, okay? The mutual fund company is the chef. All the different ingredients that are used, like flour, sugar, butter, those are different types of investments that get put into a mutual fund, okay? And so the mutual fund company will go ahead and create a mutual fund or a pie with all these different ingredients or different investments. And you as the investor get to take a slice of that pie. And just like if you went to the store and bought a slice of pie, or a restaurant, you wouldn't own any individual ingredient inside the pie. You would just own the slice of pie as a whole. Same thing here with a mutual fund. You don't own any one of the individual investments. Those ingredients are owned by, or investments are owned by, the mutual fund company. You just get to take a slice of pie as a whole. So if you really look at it that way, it's a very simplistic idea, and really that it's a really good analogy of how a mutual fund, is structured. And so now the mutual fund company or the chef can make all sorts of different pies. They can make all sorts of different flavored types of pies. And you're going to see that within your plans. You're going to see all these different types of mutual funds. And we're going to go through some of those categories. We're not going to be able to go through all of them because there's so many mutual funds, literally thousands of mutual funds, because anything that gets traded on the market can be packaged into a mutual fund. And I do mean thousands upon thousands. And so stocks, bonds, foreign currencies, commodities, you name it, if it gets traded, they can package it, and they probably have, into a mutual fund. In fact, there's already mutual funds for cryptocurrencies and stuff like that. So, so we won't be able to cover, all of the categories within a 401k plan or employer-sponsored retirement plans, but we are going to hit some of the more common ones that you'll see within the plans. So the mutual fund companies, like I said, they can offer a whole slew of different pies. Just like if you went to a restaurant, they don't usually have just one pie. They usually have multiple flavors. Same thing within the finance industry. So they are a great way for you to get exposure to the markets if you're new to investing, because they allow you to leverage a small amount of capital into a very large investment. So what do I mean by this? So you can take something like $10,000, okay, within your 401k and buy into a mutual fund which is worth like $10 billion. Okay, so that's how you can leverage a very small amount of money into a very large investment. That's what I mean by that. The vast majority of mutual funds, I mean, they're worth at least hundreds of millions of dollars to billions of dollars. And so they hold a lot of different investments. And because of that, they give you diversification. So, and I'm going to do a video about the word diversification because there seems to be a lot of misconception about this. But they can buy into a whole bunch of different investments. So some mutual funds are just stock-based. So you can consider it like a blueberry pie, right? It's just kind of one thing. But they have a whole bunch of different stocks of different companies. So it might have a whole bunch of different blueberries of different types, and varieties in the blueberry pie. And that's kind of how you can see these mutual funds. They have so much money into the mutual fund that they can buy into a lot of different investments, which then gives you diversification because they're not buying all into like the automotive industry. They could be buying into the automotive industry and the tech sector and into the finance sector and to, utilities, and they could go into a whole bunch of different companies. And so it's a great way to, again, leverage a small amount of capital into a very large investment and get diversification all at once. And on top of that, because they are institutional investors, some of these funds allow you access into investments you otherwise wouldn't be able to get into as an individual investor. So there's a lot of benefits. There are a lot of benefits to mutual funds. And so then, the question begs to be asked, okay, what are some of the drawbacks? So some of the drawbacks is that they're enormous. And so they move slower than the stock market. So if the market has really big gains, you're not going to see huge gains on your mutual fund. You'll see gains, but they're not going to be enormous. And it's because there's just so many investments. And also, they don't trade like stocks. So stocks will trade what's called intraday, meaning the market opens, they trade, and then the market closes. And that's their trading time frame, right? Traditionally, there's after hours trading, but we won't get into that right now. But for our purposes, what everybody knows is that it opens up at 7:30 in the morning, and it closes at 4 o'clock in the afternoon. And that is Eastern time. Okay, do not, if you live like, in other time zones, obviously it's going to vary, but it's based on Eastern time because the NYSE is located in New York. So 4:30 Eastern time, opens at 7:30 Eastern time and closes at 4 o'clock Eastern time. Okay, so then it trades during that day. Well, mutual funds don't trade during the day. They only trade once. They don't trade multiple times. They only trade once, and that is at the end of market price every day. So because of that, you're going to see the price movements be a lot slower, the gains a lot slower, but also the downturns a lot slower. So there's that kind of a drawback, but at the same time, it can be a benefit depending on how the markets are performing. So that's where some people like it, some people don't. It just depends on your personal preference. But if you're in a 401k, you don't really have that choice. That's what's going to be offered. So there's that structure. Also, the capital gains and the tax implications that come from mutual funds. That is also, to some extent, a drawback for some investors. Other investors, they're fine with it. If you have, the mutual funds within your 401k or your employer-sponsored plans, it won't matter because it's all tax deferred. So those tax implications don't have any bearing on those types of accounts. So it's fine. And if you're not sure what a 401k or employer-sponsored retirement plan is, I did a video on that, and it's called Investment Accounts. So you can just find it in my channel and watch that, and it'll give you a nice overview of what that is. So let's talk about some of the bigger categories you're going to see within the 401k or retirement, the employer-sponsored retirement plans. So again, you guys bear with me. I'm a little exhausted today. So we're not going to go through all the categories because, again, there's too many, but we are going to hit some of the big ones, and we're just going to start with a couple of them tonight, and then I'll make other videos about the other categories that you'll see within the plans. So the one that is very common that you're going to see in there is what's called the Stable Value Fund. That's basically like a money market for the plan. Okay, it's the steady Eddie of the group. This is plain vanilla. It's not anything fancy. It's not anything glamorous. It's not designed to knock your returns out of the park. Okay, it is designed to keep things steady, level, and smooth. So it's not going to have a lot of gains, and it's not going to have downturns. So it is money market. Technically, it can have a downturn, but historically, it doesn't have downturns. And so it's just to keep the account balance steady. Okay, it's not going to give you a lot of return though, so be well aware of that. Okay, but that's the most common one that almost all plans offer. Okay, with that, the next step up from that would be a bond fund. So again, mutual funds can be very asset specific. So in this case, it's just bonds. And those could be government bonds, corporate bonds, high yield bonds, investment grade bonds. They could be whatever, depending on how the mutual fund is structured. So there's different categories for this, and we'll go into just a couple of them. Some of the more common ones that, again, you see. So you'll see ones that are like total return, you'll see ones that are like high yield, and then you'll just see ones that say intermediate term or just a bond fund. Okay, so let's break down some of these. So total return, those are going to be usually what are called investment grade bonds. They're going to have, a lot of high-end corporate bonds with high-end government bonds. So what I mean by high-end is that these are companies or government entities that don't really run the risk of default. They are considered investment grade because they're more stable. So you're going to see a lot of those available inside 401k plans. they're going to give you more growth than what's available through the stable value fund, but they are also going to introduce volatility, something that you don't get with the stable value fund, hence the name stable value. So with the bonds, because they do trade in the market, individual bonds trade in the market, you're going to definitely see more up and down movements and volatility associated with the bond funds. Okay, so total return, again, most of those are going to be more investment grade and usually a mixture of government and corporate bonds. And then depending on some of them, some of them will have some international exposure, some of them won't have any international exposure. You just have to look at the fund to see how they've got that broken down. You'll also have like high yield or high income funds or bond funds. Okay, those are basically, I hate to say it, but they're like junk rate bonds. So that's really what they are. So there's really no gentle way to say that. So those ones, they can go into a whole slew of different categories for high yield or junk grade bonds. But if you see where it says high income or high yield, that's what it's referring to. It's referring to the investment grade of the bond, which is considered junk grade. Now, that doesn't necessarily mean that the investment is bad. A lot of people automatically assume if a company has junk grade status, that it's no good. That's actually not the case. A lot of people will just automatically assume it's financial distress, and that's actually not the case. The rating companies have a whole arsenal of reasons why they would give a company junk grade status. And so let's go over just a couple of those. Like, if a company's too small, well, not too small, but the company's small, but even if their financials are really good and their product is really good, their access to capital is going to be more limited. What do I mean by this? So if a company is small and they decide to issue stock, and a lot of people are not aware of the company, they're going to have a hard time finding buyers, right, to buy their stock. Whereas like a big corporation like Google, they have endless access to capital, it seems like, because they could issue new stock and people are going to buy it because they know what Google is. But a small corporation, when they issue stock, people might not know what it is, and so they might not get a lot of buyers, which means that they don't get a lot of capital flowing into their company. So right there, that puts them at risk, and so they can get junk grade status, even though if the company is solid and they have a good product, their access to capital might hinder them in their rating. Or it could be a mid-sized company, like maybe something that's well established. It's not enormous like Google, but it's a smaller firm, but not a startup. But it's doing pretty well. They offer, let's say, like 5 products into the market. They have good financials, fairly decent access to capital. And the rating companies are like, hey, we think you should be offering like 10 things into the market instead of 5. And the company's like, well, we really do these 10 or these 5 things really well, and we'll expand on them, but we're not going to go beyond the 5 products. So then the rating companies are like, fine, and they'll knock their ratings down. Or it could be a big corporation. They could have, heaven knows, there's been big corporations that have hit junk grade status. So let's say, for instance, that there's a dispute between management and workers. If that dispute doesn't get resolved, that's cutting into their profits. The rating agencies don't like that, and so they'll start cutting down their ratings. So it could be a whole host of reasons why a company will get junk grade status. But this is a great opportunity to get higher yield, because if a company has a lower grade status on ratings, they've got to entice investors somehow to buy into their company. So the way that they do this is that they give a higher yield, hence the name high yield or high income fund. So that's a great way for you to get some higher yield, and you definitely get more risk exposure to that. So you're going to get more volatility associated with it, but then you can also get higher returns off of it. So you can consider like a high yield bond fund like a really liberal conservative, okay? Bonds in general are conservative investments anyway by nature, but high yield is like a very aggressive, a very aggressive conservative. So you can view it that way. So it's going to introduce, again, more volatility within the fund because it's going to go and take on more risk. So, but again, with risk comes higher potential for higher reward. So take that in stride when you're looking at your investments. And then the last one I'll talk about is the balanced fund. So it's just like it sounds. It's a mixture of stocks and bonds, right? It can be anywhere from a 50-50 to a 60-40 mix, or even a 70-30. And so most of the time it's more closer to a 50-50 or 60-40. Every once in a while you'll see one that's like a 70-30 mix, but that's pretty rare. So at least in my experience. So it's going to have, stocks and bonds. So now, because you've already introduced the bond component, which has a little more volatility than the stable value fund. But now you're introducing the stock component, which has got a lot more volatility than the bond fund and the stable value fund. So the balanced fund, definitely you're going to see more movement with it. And that's because you've now introduced stocks into the portfolio. So there's a quick overview of some of the funds. We're going to go into other ones in the next video, and I promise I'm trying to do better about getting these posted in a timely manner, but life is a little crazy, so trying to keep up with this for you guys. But we'll go into some of the other, categories with the other videos, and as always, if you guys have any questions or any topics that you would like me to discuss, please let me know in the comments section. And of course, hit the subscribe button, and I will talk with you guys later.